All right, why don't we get started? So thank you very much for joining. So my name is, excuse me, Mark LaMonica. I look after the individual investor business for Morningstar here in Sydney. And today we're going to talk about transitioning your portfolio to prepare for achieving any sort of goal, but retirement's a pretty big one. So we'll kind of focus on that, although works for any goal. And I think there's one thing that we've learned, obviously, with what's happened in markets this year. It is important to go through this process. So anyway, before we get into it, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, get a copy of our FAP from our website, morningstar.com.au. And if you would like personal advice, you should contact a financial advisor. All right, so why don't we get started? So, of course, you can listen to our podcast, follow us on Instagram. Despite the no personal advice thing, questions are always great. So ask away questions about this or just in general about what's going on. I do know that this is a stressful time for a lot of people from an investment standpoint with all the economic news we're having. And, of course, what's going on with markets. All right, so we're going to talk a little bit about retirement. A fair amount about retirement for this, because that's obviously a pretty big transition that people go through. But remember, this does apply to kind of any goal that you're looking at. We can talk about sort of that transition your portfolio typically makes over your lifetime. Okay, so we've got a couple retirement checklists. We won't go through all of these topics today, but one thing obviously is setting goals. So setting goals involves determining how much you need to actually pay for that goal. So of course that's important. So for a retirement perspective, we're doing two different things. We're going to figure out our income needs per year. Then we're going to figure out a withdrawal rate. And that of course will give us the portfolio size. Then we're going to need to think a little bit about, and we'll spend some time talking about this today, we need to think a little bit about your own personal situation. And are there opportunities to potentially have a fixed or flexible withdrawal rate? And that will play into this whole thing. And then, of course, we need to transition to retirement and use super to minimize taxes. So we're not going to talk too much about most of this today. We're going to talk about how once we have this basis, what do we actually do with our portfolios? All right, so this is an incredibly ugly slide. But anyway, I made it. I don't have anyone to blame but me. But I want to talk a little bit about a glide path. So one of the things that has become big in terms of retirement planning, I will say more outside of Australia than inside of Australia, is the notion of a target dated fund. So a target dated fund is simply a way for a funds management company to sell a sort of holistic solution to somebody that actually adjusts over time. So basically what you do with a target dated fund is you pick the year that you are going to retire. You don't have one for every year, but ballpark. And then the target dated fund will automatically adjust the asset allocation in there to meet your needs. So one of the problems, of course, with using a professionally managed product is the fund manager doesn't know anything about you. So they don't know about your specific goals. They don't know about when and what you're trying to achieve. And obviously what that is it's up to you or your financial advisor to do that. Target dated fund is supposed to solve for this problem. And what they do in a target dated fund is they have something called a glide path. So a glide path simply refers to how asset allocation changes over time as you approach that retirement date. And then certainly beyond it, right? Because retirement, of course, is not just an event that occurs. You then actually have to be retired and still invest and still maintain your portfolio in order to fund your retirement. So that's what a glide path is. Now, there is no sort of single approach to a glide path. So basically, when you increase this allocation to defensive assets and how much you increase that allocation to defensive assets, different companies that have target date retirement funds have different approaches to it. But this is sort of the notion that we've all been, at least at a high level, taught, right? That you want to get more conservative as you get older. So the point of this discussion is not to talk about a glide path per se, but the point is to talk about why that glide path is important, and then how you can actually figure out your own portfolio without using something like a target dated fund. All right, so let's spend a second on glide path just so we can think about it. All right, so there are all sorts of reasons that would influence the degree that you reallocate your portfolio to defensive assets. And they're all very personal. So even though this is an attempt by the investment industry to solve this problem, it really doesn't do it for you. And the problem, of course, is there's lots of things, even if we're not talking about necessarily assets, but there are lots of assets outside of this one account that we're looking at here that could, of course, influence what kind of retirement you're going through. So a couple of them, overall level of assets, and we'll talk about why this is important. It is better to have more money than less money. And the reason that it's better to have more money than less money, and I know you're probably sitting there thinking, no kidding. The reason that it's better is that it typically can allow you to be more flexible with your spending plans. So very simply explaining this, and this should be obvious to most people, that everyone's budget and the amount of money that everyone spends is made up of, needs and wants. So, and I know there's some gray area between the two of them, but as humans, we need a couple things. We need shelter and we need to feed ourselves. And obviously, the more money you have, the more you are going beyond those sort of primal needs into wants. And we can get into all sorts of arguments about what's a need and what's a want. But the point is, generally, if you have more money, there is more flexibility in your spending because you don't need to go on a trip to Europe, right? That is definitely a want. So if there are falls in the market, if you do need to reduce the amount you can take it out, and I'm not saying that that wouldn't personally be a terrible thing for you and your retirement dreams and everything else, but you can still do that and survive. If you don't have that much money and you're barely covering your needs, you're barely covering what it costs for shelter and what it costs for food, then of course we can run into some problems. So of course a target date fund doesn't take any of that into account. So what would that mean? It would mean that if I have less money, if I'm barely able to cover my needs and wants, then volatility could have a bigger impact on me because it could actually mean that I can't cover those. So what does that mean? If volatility has a bigger impact on me, it means I probably need to be more conservative. Now, of course, I'm sacrificing future returns for that, but I really don't have a choice because I have a very small buffer. Other sources of income, of course, matter as well in this same conversation. If you do qualify for the age pension and that does cover perhaps your needs, then maybe you can be a little more aggressive. You could also have other sources of income in terms of if you own an investment property and you're collecting rent on that, that could be another source of income. Another source of income could also be, of course, your family situation. So perhaps your spouse is still working, and that can be a way to support you. The other thing that I think is important to take into account that we don't really do in a target date fund is, and we'll talk about this, what we're really trying to do in portfolios as we transition to a goal, as we transition to retirement, is we're trying to limit volatility. And we'll talk about why we want to do that. But look at what's happening right now. Obviously, there's a lot of volatility going on in the market right now with a pretty significant drop. But there are other ways to do it other than going to defensive assets. And we do need to be very careful that defensive assets are less volatile. Does not mean they don't go down. We've seen that this year, obviously, with bond returns. So the only thing that doesn't go down is cash. Now, of course, cash is a problem with inflation, and unless you lose cash somehow. But if you put cash in a bank that's regulated and not in some crazy crypto exchange, then you're not going to lose your cash. But of course, we have to worry about inflation. But this year is a good example of where we've had both shares and bonds go down. And this is perfectly natural. And this happens a lot. Bonds have gone down less, which is what they're designed to do. But just remember, I think we're sort of taught and people intuitively believe that somehow they have an inverse relationship, that shares go down and bonds go up in price. They don't. So this is certainly a situation where everything's going down. And just remember, when interest rates go up, bond prices go down. Generally, when interest rates go up, we have share prices come down. Now, there's some exceptions to that, but just remember that. So what are some ways that we can make our portfolios less volatile? So one thing to do, and all of these, really what we're doing is we're kind of looking at safety here in a way, but we can choose large cap shares over small cap shares. So why are large cap shares less volatile? Because large cap shares, so these are quote unquote bigger companies if we're looking at market capitalization. Why? Because they're generally bigger companies, right? This is what they're worth, but they're generally bigger companies. They generally have more diverse product ranges. They generally operate in more diverse geographies. They generally are in better financial shape, and they're more easily able to raise capital versus small cap shares. So generally you're getting small cap shares bounce around more than large cap shares. Now, if you invest in small cap shares correctly, you could earn a higher long-term return. But remember, that's not what we're focused on here. We are focused on limiting volatility. Dividend-paying companies are less volatile than non-dividend paying companies. And interestingly enough, there are many studies that indicate that over the long term that the returns are actually higher, which is sort of a free lunch in investing, that you are getting higher long-term returns and lower volatility. So why are they less volatile? Well, number one, obviously, just the fact that you're paying a dividend says a lot about your company, that you're probably cash flow positive, that typically you might be a larger company, that you're in better financial shape because you're choosing to pay a dividend, all sorts of different reasons. And dividends, of course, are a source of return. And I have a feeling over the next couple of years will be a more important source of return. All right, third point, non-cyclical companies is something we don't think about. We're talking a lot about the possibilities of a recession right now. And a cyclical company, of course, is a company that goes with the business cycle. Typically won't do as well when the business cycle is going in the opposite direction that we want. A non-cyclical company will just kind of stay the same. Now, obviously, there's all the other factors that influence a company. Is management doing a good job? Are they putting out good products, competitive advantage? But generally, they are not bucked by the income cycle. So when you think about non-cyclical companies, we can think about things that have consumer defensive goods, right? Things you're going to buy no matter what. No matter what, you're going to go to Woolies and Kohl's. No matter what, you're probably going to buy a Coke. Companies that, and alcohol, interestingly enough, although it is probably more a want than a need, people don't stop buying alcohol in recessions. So those are non-cyclical companies. So once again, they will be less volatile typically because they're not following that business cycle, not going down when economy's not doing well and then going back up. So what are cyclical companies? Generally resource companies. And think about this with Australia, right? A lot of cyclical companies in Australia. So they're generally resource companies. So resource companies, of course, are inputs into construction generally. And construction typically falls when we're in recessions. They're financials, so banks. So the interesting thing about banks, and we've all seen this with banks in Australia, initially, as we sort of flipped our mindset from interest rates aren't going up till 2023 to they're going up sooner and have gone up. First, we were saying, of course, and this is true, that banks tend to perform better in those higher interest rates, those rising interest rate environments, of course, because there's a lag between when they are going to hit up the people that they've lent money to versus when they're actually going to give that to savers. But what we've seen recently is after doing okay initially, the banks have really taken a hit. And they've taken a hit because now there's the worry that central banks are going to push the economy into recession. What happens in recession? People don't borrow money and you start getting bad debt. People can't pay back their money, both of which are not great for banks. Quality companies. Now, quality is obviously a term that is can be defined in many different ways. A lot of what I was talking about is quality. So what they look at typically when they're looking at quality companies is you're starting to look at companies that are in better financial shape. So think large cap can kind of get that. Dividend paying gets that a little bit. You're looking at companies that are non-cyclical because you're looking at the variation of their earnings over the years. Are their earnings bouncing around a lot? Well, you'd expect to see that in cyclical company. So yeah, we're looking at moats, things like that. So competitive advantages and lower business risk companies. So at Morningstar, we have an uncertainty rating. So that lower uncertainty rating. And the reason for this, when we're talking about business risk, is some companies are just naturally riskier. And we've covered a lot of these points, right? Like obviously, if I'm Coca-Cola, I'm less risky than a small biotech company. All right, so there's some glide path considerations in general around your portfolio, but just one of the things you don't get from some of these cookie cutter approaches to these portfolio transitions. All right, we do have two questions, which we'll just get to right now. Oh no, this is just a nice comment from Cynthia. Says it's been stressful lately watching my super go down when I'm close to retiring. Hopefully next year. But I found comfort in your recent emails and these webinars. Thank you. Okay, well, thank you, Cynthia. That's very nice of you to say. And then Lisa of Alpaca Fame is saying, is this a reasonable time to buy large cap U.S. stocks, especially tech? Yeah, I mean, it's certainly an interesting question. What I would say, and I'll touch on this briefly, and then I can go into it more later, is valuation levels have not come down that much. So we were at such, particularly at the U.S., right? We were at such a anomaly, historical high in January that they've really come down to average right now. So if we look at overall valuation levels, right, they've sort of come down to average at this point. So what I would say is shares are no way cheap, despite the fall. I think there's a lot of concerns right now around kind of the earnings side of things. But yeah, some particular names have come down a lot. So, I think it kind of depends upon the name. There's been sort of this separation between profitable tech companies and non-profitable tech companies. Don't forget that there are a lot of very profitable large technology companies. So sorry, they kind of around your answer a little bit, but I can't tell you specifically what to buy. All right, let's talk a little bit about retirement. Then we'll talk about approaches you can take. And these are some things to think about, I think, if you're approaching retirement like Cynthia is. Okay, so I'm not going to go through all of this, but very simply, this obviously is a challenging time for many investors because over their entire working lives, they've gotten very used to the notion of saving money and investing it. So that's great, but now how and what do I need to worry about taking money out all of a sudden of my super and starting to spend it? So we are looking at two risks, and I've talked about these risks a lot. Let's think about them in the context of what is actually happening now. All right, so the first risk, of course, is sequencing risk. So sequencing risk is as you're approaching retirement or when you're in retirement, the market falls significantly. And the problem, of course, is like if we look at, let's just say the markets fell roughly 20%. Now, obviously, sort of NASDAQ, tech, fallen a lot more. Australia has fallen less. If you're an Australian investor in a non-hedged international portfolio, you've done better than that because the Aussie dollars fell this year. But anyway, let's just say 20% for the sake of argument. So if things have fallen 20% and all of a sudden you are starting to take money out of super, of course, that's a problem for you, right? Because of that fall means that you are selling, number one, after the market has fallen, which generally is not a very good idea. And then number two, you are not going to have as much money for when the market recovers because you're taking money out of it. So sequencing risk, and we won't go through all the sequencing risk sort of slides that we normally go through, but sequencing risk, that's a problem. So basically what that means is that you'll run out of money faster. The other risk, of course, and I think is also appropriate to what's going on now, is longevity risk. So longevity risk, of course, is the risk that you outlive your money. What it means is that you basically invested too conservatively. Because the problem, of course, is that you have no idea when you're going to die, which makes it very, very difficult to plan. So going too conservative can mean you run out of money. So these are the challenges we face as retirees. And these are certainly challenges that we are facing right now, because both of these Sequencing risk obviously is directly triggered by a falling market if you're about to or just retired. Longevity risk, our reaction generally to falling markets, which is generally not beneficial to us, is to get conservative and sell. And that, of course, can impact longevity risk. All right. So go through a little bit of how you kind of mitigate both these risks. So let's talk about longevity risk. Once again, as I said, you have no idea when you're going to die. That's a problem. If we're looking at a large pool of retirees, which is what we used to do when we had pensions, it was a lot easier to figure out because we can figure out when the average person dies. But of course, you are not average. And if you happen to live significantly longer than the average, that can be a problem with longevity risk. So how do we address that? As I said, we keep invested in growth assets. And that's what they have to worry about during those target dated funds on those glide paths, right? To not get too conservative. And some of them actually accelerate after a couple of years of retirement, go back up in terms of growth assets. So sequencing risk. So once again, we talked about what that is. It's not the average return you get over your lifetime. It's the order of returns that will also determine how long your money lasts. So how do we do this? We, of course, get more conservative. So if we don't want our portfolio bouncing around a lot as we retire, once again, it's on that glide path, we go to more defensive assets that don't bounce around as much. So as you probably figured out here, the way that we mitigate both of these risks actually contradict each other. This is saying stay invested in growth assets. Sequencing risk is saying move to defensive assets. So that is our problem, right? So that is what we're trying to solve with a withdrawal rate. We'll talk about some other ways that we can do this. All right. So volatility, and I know that it's worrying for everyone. So basically the market going down is worrying for everyone. It's worrying if we're approaching retirement, but it's also worrying for a lot of younger investors. But volatility is not really what we should be concerned with. It's easier said than done if we're younger investors. We should be concerned, of course, with those long-term returns and staying invested. But anyway, we're going to focus a little bit on this portfolio transition. So the theory that's in that glide path is that we, of course, lower volatility by moving into more defensive assets, right? We do that on an aggregate basis in the portfolio because with a target date fund, for example, the way that we take money out of that is we sell a little bit of everything, right? It's not like having your own self-managed super fund where you can literally pick the assets you want to sell. If you're invested from a theoretical standpoint, well, not from an actual perspective, if you're invested in one of these target date funds, you would just sell the fund and the fund would sell everything. A little bit of your defensive assets, a little bit of your growth assets, etc. But in practice, the way that we want to deal with volatility is we want to make sure we're not selling those assets, that we're not selling those assets that have fallen the most in price, because those are the more volatile assets that have higher long-run future returns, so that we can actually go there and pick them. So let's talk about a couple of different ways we can do this. And there's kind of two different ways. So number one, of course, how do we not sell during a market dip? Well, is there a non-portfolio source of funds? Do you have anything that allows you not to sell? And I do understand that superannuation makes you take money out of your portfolio. So yes, you're physically selling, but you don't have to buy something with it, right? You can remove that money from your super, buy something in a taxable account, and basically replace it. We're talking about not spending the money and not having the money be unavailable for when the market rebounds. Now, this is all very nice to say, find a non-portfolio source of funds. Most people don't really have that option, right? But this would be a situation where we would focus on, okay, if you're on the age pension, for example, if you've got investment property, if you've got assets outside of super that are generating dividends, potentially your partner still works, let's think of ways not to have to really sell our super assets, not to really take money out of the share market, even if we're moving it into a taxable account. The other thing is, of course, source funds from your portfolio without selling off your assets. So how do you do that? It's just taking money out of cash, right? And we'll talk about that, the bucket method. And we'll talk about the other way you can do that, of course, is that if your portfolio is generating enough income for you to live off of. So those are the two things that we're going to talk about today. So I think we got a couple. Oh. Okay, so Rita has a good question around this. So Rita says, if you are in retirement, you have a super account and 12 months worth of savings in the bank, can you stop your super from paying out, put it on hold once it started, and use your cash instead? Not unless the government lets you. So this is basically what happened during the volatility we saw around COVID. Government came out and said, okay, we are going to reduce the amount, knowing this, right? The government knowing that we do not want to sell into a huge market drop. Now, obviously, that drop lasted for a very, very short amount of time. But along with all the other COVID policies, the government said, okay, you don't have to take the whole mandated amount out of retirement. All right. So that was their policy reaction. But unfortunately, unless that happens again, then yes, you do have to continue to take your super out. But I will say is that you don't have to spend it, right? You can invest it outside of super. There's different things you can do there. I think people think that the mandated amount, depending upon your age, that you have to take out of super, that you just like the government's telling you just go spend it. Well, they're not. They're telling you that it has to come out of an account with a tax advantage in it. But you can go invest it in some ComSec account outside of your account if you wanted. But unfortunately, no, you can't do that, Rita, unless there are policy changes. And it was interesting when the government did that during COVID, of course, is that they're saying the opposite to young people. Even though the market's dropped a lot, they're like, oh, well, if you need money to live on, just take it out of super. Thought it was a pretty unfair policy decision. I get sort of why they did it, that people needed money, but there's another way to get people money. Anyway, I'll get off my soapbox. All right, so let's talk about the couple different approaches you can get. So there's sort of this notion that I think many people think is a little bit antiquated, is this whole never invade your principal thing. So pretty much just saying that, okay, if you can get in a situation where you can live off of the income generated by your account, you're in very good shape. So what this means is either from dividends or from interest, that you're able to live off of those funds. Now, once again, there is that super nuance. If you don't hit those mandated withdrawals, then of course you might have to sell assets, but you can of course invest them again. So this is nice. The hard part about this is you need to have a lot of money. And while yields have gone back up as the market has dropped, and these are a little bit out of date, you still need to have a lot of money to do this, especially with valuation levels where they were and frankly still are. So this was a lot easier to do in an environment where you could go out there and generate a meaningful amount of income from your portfolio. Right now, you're getting nothing from cash. You're starting to get more from bonds, which is helpful. And as the market falls, as long as we don't have dividend cuts because of economic issues, as the market falls, of course, that yield goes up. The thing that you have to worry about, just what I said, excuse me, around that market drop is, looking at the US, the S&P 500 dividend level dropped by 25% in the GFC. Now, the S&P 500 went down almost 50% during the GFC. So that is better. It is less volatile. That dividend income was less volatile than the, just value of those shares, but still there is volatility. So yeah, if you're lucky enough to do that, that is a good situation. So what that means is you can kind of be more opportunistic about when you sell assets. So if you're able just to live off of that income, have it either build up in your account, do some asset sales when the market's when the market's high and valuation levels are high. And then as the market drops, you can stop selling, just continue to live off that income. So it's a nice situation if you can find yourself in it. The other approach you can take, which I talk about a lot on here because I like it, is the bucket method to asset allocation. Now, once again, this is a little bit tricky with super, and it is especially tricky if you do not have a self-managed super. You do have a self-managed super, this is a lot easier to do, but this is difficult to do if you have like an industry super, for example, because it's harder to sort of manage this process because you're not really setting the asset allocation unless you're in their sort of more expensive side of the product where you actually go in and pick all your own investments. So there's a little bit of a challenge, but anyway, let's talk through what it is. So basically what we're saying here is the bucket approach is looking at dividing your assets into different buckets. So either 2 or 3 different buckets. And the idea behind it is you put cash in one bucket. That cash, of course, and depending upon how conservative you are, depending upon your own personal situation, that cash should be multiples, at least a year worth of living expenses, perhaps multiples. So how long basically you want to be able to hold out only using that cash without having to sell. So basically how long you think that a market downturn will last. More conservative you are, the multiples of years, you have 3 years of living expenses and cash, et cetera, et cetera. Then in either the 3 bucket scenario in buckets 2 and 3, or the 2 bucket scenario in bucket 2, that's where you have longer, you have assets that you want to invest for longer. So basically riskier growth assets. And the idea is very simple. On a normal year, what you'll do is you'll just sort of keep recycling money through these buckets. So you'll sell those longer term assets, replenish the cash bucket, take the cash out to pay for your life. But in years like now, potentially, where there are more extreme market events, you don't sell. Instead, you're just drawing down that cash. And obviously, at some point, you'll have to replenish that. But the hope is that the market's recovered by the time you actually have to sell things again to replenish that cash bucket. Of course, the risk is if you don't have enough cash to see it through the entire market cycle, right? So then what you're ultimately ending up doing is when you run out of cash, then you are just selling at even lower valuation levels if the market drops over multiple years. So that is the bucket approach. And I just want to throw this up here. These are not all technically bear markets. And I left off that COVID thing because that lasted a very short amount of time. But anyway, what these are basically either bear markets or really close to bear markets. So a bear market is when the market falls by 20%. And these are US returns. But I just wanted to demonstrate how long it potentially takes in a couple situations to break even. So the big ones, of course, 73. So that's a nifty 50 crash. So 46 months to break even. So that's obviously a really long time. This is the dot-com crash right here, 48 months. It's again an even longer time. And this is the GFC, 37 months. And you can see the size of some of these extreme drawdowns. So these 3 are obviously very, very bad. So that's what you're trying to consider with the bucket method and how safe you want to be, how much you want to keep in cash. All right, I want to do that. We got some other questions. All right, what do we have here? Okay, so Rodney has a really good question. So he's saying, even with an industry super, I actually went back and forth over email with this with somebody. Couldn't you have it say high growth? So high growth would be that sort of preset asset allocation that you're selecting, and then hold your cash buckets outside of super and manage the accounts and the amounts in each. You could. The problem is, right, that when you have mandated withdrawals from super, you're still going to have to sell. Now, once again, you can sell out of super and then reinvest it in something else. So basically holding that cash bucket. And we think about the other thing that's really important when we're talking about all of this is sort of asset location, right? So what do you want inside of super? Well, inside of super, of course, you want the highest returns, the highest tax consequences for you, because of course the taxes are lower. Whereas outside of super, holding cash is pretty cool because you're not getting anything on it, right? So you're not paying a lot of taxes because you're not getting a lot of return. So you can do that, but you still have sort of this weird round trip in super where you would have to sell and then buy something else. And I think, the advantage in this case, and there are disadvantages of self-managed super funds, but the advantage is, of course, that because you would have more say over your asset allocation, because of course it's self-managed, you could keep that cash bucket in super and use that to fund those government mandated withdrawals. Yeah. So Rodney is saying, yes, you could leave the super in accumulation mode, but then you're paying taxes, right? So you don't get that tax benefit of moving funds into pension mode. So yeah, no, it's a good point, Rodney. So there's obviously a lot of very, sort of personal and potentially complex tax issues around all of this. So that is important to note. Okay, Lisa says the GFC drop took about a decade for the market to recover. Is 5 years of cash bucket enough, considering the U.S. is at a risk of recession? Yeah, I mean, listen, I can't. I mean, I think the thing is, Lisa, I can't obviously predict the future. I wouldn't say the U.S. is the only one at a risk of recession. Like, there are problems in Australia, problems that we don't necessarily even know, right? So one of the weird things about Australia is that there are not monthly inflation readings in Australia. Now, you got to assume that the central bank, that the RBA, has informal surveys and information that are coming out here, but Australia is the only member of what the G8 that doesn't have monthly inflation ratings. So they come out quarterly, and there's a big lag between when they come out. So I think we'll see what's happening in Australia. So obviously, we had the pronouncement, Philip Lowe, last week, right, that said he thought inflation was going to be at 7% at the end of the year. He also thought that rates weren't going up till 2023. So I don't know if the RBA has the most credibility right now in terms of their ability to predict. But yeah, anyway, what I would say, Lisa, is yes, I don't know. I obviously don't know what's going to happen with markets. I think if you were having more than 5 years of cash, and incidentally, that's what I have for my mother. But she has sort of a 2-bucket approach. And obviously that's based on her own personal situation. But yeah, I would say more than 5 years, you're starting to hold a lot of cash. And just be careful if inflation obviously doesn't get under control. Be careful with what that cash is actually going to be worth in 5 years. So that's my only comment there. Yeah, so Antonio is saying, within a retirement income stream, is it possible to invest, say, 40% in high growth fund and the remaining 60% in conservative fund? So what you'd have to do is you'd have to go look at your super account. So depending upon who you use from a super perspective, so basically what that would be, sort of that 60-40 thing you're saying, or 40-60 in that case, what that would be is essentially, it's a bucket method at the end of the day. But go check out your super. So a lot of supers, what I will say is a lot of industry supers do not let you select the asset you want to sell, right? So you can be in only one premix, and I'm generalizing here, but you can be in only one premix and can't go in there and pick the asset. That's the advantage you have, of course, around a self-managed super fund. So you can pick the asset. Number one, you can pick the asset if you want to just withdraw cash. You can pick the asset if one share did really well and one did really poorly, and you don't want to sell that when it's low. So you lose some of that flexibility. Now, of course, you pay higher fees, and it all depends upon how big your account is, whether those fees that you're paying for accountants and everything else make sense. But good question. All right, so Rodney has a good suggestion for a future one. Emily and I are actually talking. I'll save this. Rodney, Emily and I were talking about the next round of these. So there you go, Emily. Now you've got an idea. I just do whatever Emily tells me to do. All right, got a couple. So Phil says, recommend anyone to investigate for bond portfolios. And Lisa had a suggestion. Yeah, I mean, obviously you can look at our ratings around different bond funds and ETFs. So a couple things that you should be aware of. I should be aware that my computer is going to run out of power. I'm going to go ahead and plug it in. I should have done this before. There we go. So a couple things to be aware of. So of course, it has not been a great environment for bonds. So bonds, of course, generally do not do well in inflationary environments. They don't do well when interest rates are going up because bonds move inversely to interest rates. So prices go down when interest rates go up. So there's a lot to worry about with bonds right now. So I would just be cognizant of that. The other thing that I'd be really cognizant of, and I said this a couple times on here, but I think people keep thinking about this. Just remember that if you invest in a bond fund or ETF, it's very different than buying an individual bond. So bonds have interest rate risk, as I said. Obviously, that price of a bond is going to move around in the inverse way as interest rates go. I think many people sort of still think a bond is just buying a bond, and you can buy bonds. It's not the easiest thing to do in the world in Australia. So you can buy a bond, and of course, you don't really care if you're going to hold that bond to maturity. You don't care if the price bounces around in between, as long as you get your money back. So as long as there's no credit risk event and you get your money back at the end. Problem is, funds and ETFs are not that way. They're, of course, a collection of bonds. They're a portfolio of bonds that's continually getting refreshed, right? So some bonds are maturing. They're buying new bonds. There's new money coming in. They're going out and buying more of everything. And so they are just a lot more exposed. Well, they don't have that trick of getting out of interest rate risk in a bond. They don't have that just wait till maturity. So just remember, as that portfolio continually is refreshed, it will continually go down if interest rates are going up. It's the only thing I would worry about with bonds. Just make sure that the way that you go out and access them, just that you understand the risks of the way that you go out and access them. So an anonymous attendee says, can you have a self-managed super fund and an industry fund at the same time? It's an interesting question. Like, what I would say is, I guess my question would be like, what are you trying to get out of that? The issue that you run into with self-managed super funds, so self-managed super funds obviously have a bunch of rules associated with them, but also there are certain fees that you have to pay. Now, those fees some of the fees are variable, but a lot of the fees are fixed, which basically means that you need a big enough balance in a self-managed super fund. There's lots of arguments over what this balance should be. But go on to First Links and sort of Google that, and they have all sorts of interesting articles around that. But the issue that you run into is that if you don't have a large enough balance to cover those sort of fixed costs for like your administration and everything else, then all of a sudden it doesn't make sense to have a self-managed super fund. So my only concern is if it's even possible, and you could certainly do this if you have a partner. Now, part of the advantage of a self-managed super fund is you can pool the money, but you could certainly set up a situation, I guess, where your partner is still in an industry fund. But I think it's really thinking about what you're trying to do there. Are you just trying to sort of manage that sort of sequencing risk from the sort of forced sales of everything? There could be a better way to do that. And one other thing that we haven't talked about at all in any of this is, of course, you can manage a lot of this through an annuity as well. So people don't like annuities in general, and they don't like them because I think everyone's very worried that they're going to get hit by a bus when they walk out of the office of where they signed up for the annuity. So an annuity, of course, is a situation where you take a pool of money, you give it to a company like Challenger, for example, big annuity provider in Australia. You give that pool of money to Challenger, and then, of course, Challenger pays you a set amount. And there's lots of different annuities, fixed and variable and lifetime and all sorts of different things. But, very simple examples, they'll give you a certain amount of money per month for the rest of your life. You're converting your portfolio into an income stream. But they've just never caught on probably as much as maybe academics think that they should. And I think it's this thing where, yeah, you hand $1 million to Challenger and it's a lifetime annuity, and then you drop dead 2 days later, you've just given them $1 million and it's gone, right? I think nobody thinks about you're lived to 100 years old and they're still paying you out, and all of a sudden you've done very well. So yeah, people don't seem to love annuities. Yeah, so Lisa's saying bonds have had their worst performing year on record at negative 12.5%, and the closest was negative 2.9%. Yeah, no, bonds have done really, really poorly. It's sort of rising interest rates, high inflation. Yeah, not a great time for bonds. All right, well, the good news is we're out of questions. The bad news is we're out of questions. So anyway, we'll finish up for today. If anyone has any questions, you can send them to me at mark.lamonica1@morningstar.com. And yes, I know everyone is very, very anxious about what's going on, but I think the important thing with all this stuff that we try to keep saying here, just make sure you're making thoughtful decisions and you're not doing things as much as possible that are emotion driven. So yeah, make sure you're making thoughtful decisions, think them through, talk them over, send me an email if you want. But anyway, thank you very much for joining, and I'll be